6%. That is how fast WTI crude fell the moment those 7 words hit the wire, from above $100 per barrel to a session low of $83.89 in under 2 hours. 7 words from a presidential phone call moved the most important commodity market on the planet with more force than any OPEC meeting, any inventory report, or any Federal Reserve statement has managed in years. Tonight, we unpack exactly what those words were, why they moved oil that dramatically, whether the move is real or a head fake, and most importantly, what it means for every energy position you are holding right now. Good evening. I'm James Harlow. Welcome to The Right Chapter. Tonight, we are in the middle of one of the most volatile oil markets in modern history, and the story has developed significantly in the last 12 hours. WTI crude is currently trading around $91 per barrel. Brent is just under 93. Both benchmarks are down sharply from Monday's intraday high of $119.50, but they are still up more than 30% from where they were trading before the US and Israel launched Operation Epic Fury on February 28th. Let's make sense of all of it. To understand today's price action, we need to rewind to just after 3 o'clock Eastern Time yesterday afternoon. President Trump was on the phone with CBS News reporter YJ Jang. The war in the Middle East was 10 days old. Oil had just hit $119 per barrel, the highest price since Russia's invasion of Ukraine in 2022. The Dow was down 900 points. Asian markets had their worst session in years. Gasoline at the pump in America had hit $3.49 per gallon, up more than 50 cents in 10 days, higher than at any point during either of Trump's terms in office. The political pressure was immense. And then Trump said this, and I want to quote him accurately because every word matters in this context. He said, "I think the war is very complete, pretty much. They have no navy, no communications, they've got no air force," and he added that the US is very far ahead of his initial timeline. Those words, posted to social media seconds after the phone call ended, triggered an immediate and violent repricing across every energy market on Earth. WTI dropped 6% in the span of that session, from above $100 to a low of $83.89. Brent fell more than 3.5% below $89. The S&P 500, which had been down 1.5% at its lows, reversed and closed up 0.83%. The Nasdaq, which had been down 1.4%, closed up 1.38%. Heating oil, which had been up 23% on the day, gave back most of those gains and finished down 8%. This was not a small market adjustment. This was a full-scale repricing of the geopolitical risk premium across the entire energy complex, triggered by a single phone call interview. Now here is the part I need you to sit with carefully, because this is where the situation gets complicated and where the difference between a calm, informed investor and a reactive one matters enormously. Because within hours of those "war is complete" comments, the picture became significantly murkier. At his Florida press conference, later the same day, Trump softened his earlier statement. He said the US is achieving major strides toward completing our military objectives, which is not the same thing as saying the war is over. He said the operation is ahead of schedule, but then added that there is still more to do. He said it was a short-term excursion into something that had to be done, which is a phrase that sounds like closure, but does not actually commit to a timeline. Then on Truth Social, he posted a direct threat to Iran. If Iran does anything that stops the flow of oil within the Strait of Hormuz, they will be hit by the United States of America 20 times harder than they have been hit thus far. That is not the language of a man who believes the war is over. That is the language of a man managing two audiences simultaneously: the financial markets, which he needs to calm, and his geopolitical adversary, which he needs to deter. And on the other side of that equation, Iran's response to Trump's "war is complete" statement was immediate and unambiguous. The IRGC, Iran's Revolutionary Guard Corps, said, and I'm paraphrasing here, that Iran's armed forces will not allow the export of a single litre of oil from the region. Iran's Foreign Minister Abbas Araghchi told PBS News that the firing continues, that Iran is well prepared to continue attacking with missiles as long as needed, and that negotiations with the United States are no longer on the agenda. The IRGC spokesman said Iran's forces are awaiting the US naval fleet in the Strait of Hormuz. These are not the statements of an adversary that believes it has been defeated. This is a direct contradiction of Trump's market-moving narrative, and oil traders by the end of yesterday's session had begun to process that contradiction, which is why prices stabilized rather than continuing to fall. Here is the framework I want you to use for everything you read and hear about oil in the coming days, because it will save you from making reactive decisions. This market right now has two completely separate pricing engines running simultaneously. The first engine is the Trump engine. Every statement Trump makes about the war ending, about sanctions being lifted, about the US Navy escorting tankers, about the war being a short-term excursion, pulls oil prices down. Traders hear those statements and reduce the duration premium, the extra dollars per barrel they are paying to hedge against a prolonged supply disruption. The second engine is the physical reality engine, the actual tanker tracking data, the actual storage levels in Iraq and Kuwait, the actual IRGC statements, the actual tanker insurance market. That engine is still telling you the Strait of Hormuz is effectively closed. That engine is still telling you Iraq has cut production by 70%, that JP Morgan estimates 4 million barrels per day of regional production cuts by end of this week, that the G7 met on Monday and did not announce a coordinated reserve release. Those two engines are pulling the price in opposite directions at the same time, and that is why you are seeing $30 intraday swings until one of those engines clearly wins, until the physical situation actually improves, or until Trump's war is over narrative collapses. You should expect this level of volatility to continue every single day. There is one more development from yesterday that deserves your full attention and that I do not think enough people are focusing on. At his Florida press conference, Trump said his administration will lift some oil sanctions on other producing countries to help bring prices down. He said, quote, "We have sanctions on some countries. We're going to take those sanctions off until this straightens out." He did not name the countries, but Washington currently maintains oil sanctions on three major producers: Russia, Iran, and Venezuela. Multiple sources have since confirmed to Reuters that Trump is actively considering easing sanctions on Russia as part of his oil price management toolkit. Think about what that means for a moment. We may be looking at a situation where the US-Israel war on Iran, which has temporarily removed a fifth of global oil supply from the market, is used as political cover to rehabilitate Russian oil on the global market, which would be an extraordinary geopolitical outcome that virtually no analyst predicted 10 days ago. If Russian oil comes back to market in volume, the medium-term price picture for crude changes dramatically. That is a story I will be tracking very closely, and we will have a dedicated episode on it this week. Now let's talk about what this means specifically for energy stocks, because that is the other half of today's headline, and it is the question your portfolio is asking right now. When oil prices spiked to $119 on Sunday night and Monday morning, energy sector stocks did not fully follow oil higher. The XLE, the Energy Select Sector ETF, which tracks the largest US energy companies including ExxonMobil, Chevron, ConocoPhillips, and others, was actually volatile and uncertain rather than surging cleanly with the oil price. The reason is important. Energy companies do not necessarily benefit from an oil price spike that is caused by supply destruction. ExxonMobil and Chevron produce oil globally, but their Gulf operations and their ability to get barrels to market are affected by the same supply chain disruptions that are affecting everyone. A spike to $119 that is driven by an embargo is not the same as a spike driven by demand growth. The former creates operational chaos, the latter creates profit margin expansion. The market understands that distinction, which is why energy stocks were not simply rallying in lockstep with crude prices. When Trump's comments yesterday caused oil to fall 6%, energy stocks fell with it but recovered faster, because a lower oil price that reflects a shorter conflict is actually better for energy company operations than a higher oil price that reflects a prolonged supply chain nightmare. The smart positioning in energy equities right now is not to chase the oil price spike. It is to assess which companies have the most resilient operations, the ones that do not depend heavily on Persian Gulf logistics, the ones with strong domestic US production that is insulated from the Strait disruption. Companies with significant Permian Basin exposure, significant offshore Atlantic production, or Norwegian North Sea exposure are structurally better positioned in this crisis than those with heavy Gulf reliance. Let's talk price levels with precision, because this is where the rubber meets the road. WTI is currently around $91. Brent is around $93. The first level I need you to watch on WTI is $95. We closed just below it yesterday after bouncing off the low of $83.89. A close back above 95 tells you the market has rejected Trump's optimism and is reasserting the physical supply premium that would likely coincide with fresh Iranian statements, tanker tracking data showing continued Strait closure, or any overnight escalation. The second level on WTI is $80, a sustained move below 80, not just an intraday spike down, but a multi-day close below that level tells you the market genuinely believes the war is ending quickly and supply will normalize within weeks. We are $11 above that line right now. The distance between here and the crisis is over is $11 per barrel. That is not much room when Trump is giving multiple conflicting interviews per day. On the upside, the number the whole market is watching is $100. We crossed above it on Sunday night for the first time since 2022, held it briefly, then came back below it after Trump's comments. If we recross above $100 on the back of fresh escalation, a new tanker attack, a direct IRGC strike on Saudi infrastructure, an Iranian missile hitting a US naval vessel, the next stop, according to Kapler's lead analyst, is $150. According to Macquarie, a sustained Strait closure over several weeks gets you there without any additional escalation at all, purely on the mechanics of supply destruction. Keep $100 as your mental line between volatile but manageable and global energy crisis. We are $9 below it right now. Here is what the institutional players are telling you through their actions, separate from what any commentator is saying. The shape of the oil futures curve is the most honest signal in this market. Yesterday, even at the peak of $119, contracts for delivery in 2027 were trading in the high 60s. That tells you sophisticated, long-duration investors, pension funds, sovereign wealth funds, the people managing money over 5 and 10-year horizons, do not believe this crisis is permanent. They believe it resolves. The question is the timeline, and that timeline determines how many hundreds of billions of dollars flow in and out of energy markets in the weeks ahead. On the ETF side, the USO saw extraordinary inflows during the spike and saw significant volume during the sell-off yesterday as institutional players trimmed positions after the Trump comments. The positioning data from CFTC will be updated later this week and will give us a cleaner picture of how much of the institutional long was unwound versus how much remains. Watch that data. If large speculators maintained the majority of their long positions through yesterday's sell-off, it tells you the smart money is not convinced the war is nearly over, regardless of what Trump said on CBS News. Tomorrow morning, Tuesday, March 10th, there are two things on the calendar that will move this market before US trading even opens. The first is any overnight statement from Iran, the IRGC, or Iranian Foreign Minister Araghchi. In a conflict where a single statement can move oil 6% in 2 hours, the overnight news cycle from Tehran is as important as any data release. Set your news alerts. The second is the G7 Energy Ministers meeting, which begins in the European morning. Yesterday's G7 Finance Ministers meeting ended without a specific coordinated reserve release. They said they were ready to take necessary measures but did not announce specific barrels. The Energy Ministers meeting today is the next opportunity for governments to deploy their most powerful non-military tool against oil prices. A specific, large, coordinated reserve release, at least 1 million barrels per day for 60 days, would be material. Vague language again would be a signal that governments are waiting for the military situation to clarify before committing their strategic reserves. Watch for specifics. The word coordinated and a specific volume number is what matters. Tomorrow on this channel, we are turning to gold, which has done something genuinely puzzling during this entire crisis, and which has an important story to tell about what the professional money actually thinks is happening with inflation, interest rates, and the dollar. You do not want to miss that episode, because the gold story right now contradicts almost everything the mainstream narrative is saying about safe haven assets. Oil at $91 today, down from $119 yesterday morning, still up 30% since the war began 10 days ago. 7 words from a presidential phone call moved $30 of global commodity value in 2 hours. The Strait of Hormuz is still closed. Iran says it will not allow a single litre of oil to leave the region. Trump says sanctions on oil producers are coming off. The G7 is meeting again. And somewhere in the Persian Gulf, 150 ships are sitting at anchor, waiting to find out which of those signals turns out to be true. That is the oil market in March 2026. Stay calm inside it, stay informed about it, and stay focused on the signals that actually matter. I'm James Harlow. This is The Right Chapter. Subscribe, and I will see you tomorrow. Good night.